something happened in January 2026, and almost no one noticed. Not in Washington, not on Wall Street, not at the Federal Reserve. But it is already reshaping how global trade is settled, because for the first time in nearly 80 years, a fully operational international payment system has gone live, without using the US dollar. Not a proposal, not a pilot program, not a future plan. It is already working. In January 2026, the BRICS alliance officially activated a new international settlement system. Brazil, Russia, India, China, South Africa, and now Saudi Arabia and Egypt. Together, they flipped the switch on a system designed to do one specific thing: allow large-scale international trade without touching the US dollar. They call it the unit. This is not a digital experiment. This is not a crypto token, and this is not an announcement meant to pressure negotiations. The unit is live, operational, and already being used for cross-border trade settlements. That single fact matters more than any headline. Because, for your entire lifetime, global trade has operated inside one financial architecture, one settlement system, one reserve currency, one set of rails, the US dollar. Nearly every barrel of oil, every shipment of grain, every container of electronics, every major international contract was priced in dollars, settled in dollars, and cleared through dollar-based financial infrastructure. That system was not optional. It was mandatory. What just changed is not that the dollar was attacked. What changed is that, for the first time since 1944, a separate system now exists alongside it. Parallel, functional, and independent. The BRICS alliance did not try to reform the existing system. They built a new one, their own settlement rails, their own clearing mechanisms, their own financial infrastructure, and then they opened it for business. This matters because financial power does not come from speeches or agreements. It comes from infrastructure. Who controls settlement? Who controls reserves? Who controls access? For decades, the global financial system was centralized. If you wanted to trade at scale, you had to pass through Western-controlled systems. Dollar clearing, Western correspondent banks, US and EU regulatory oversight. That centralization created efficiency, but it also created vulnerability. And that vulnerability was exposed in February 2022. After Russia invaded Ukraine, Western governments froze over $300 billion of Russian foreign currency reserves, money accumulated over decades, held in Western banks, rendered inaccessible overnight. No court ruling, no negotiation, just a decision. For the rest of the world, that moment landed with absolute clarity. If your reserves sit inside someone else's system, they are not truly yours. If it could happen to Russia, a nuclear-armed G20 economy, it could happen to anyone. China saw it, India saw it, Saudi Arabia saw it, Turkey saw it, Indonesia saw it, and they all reached the same conclusion. Financial sovereignty requires financial alternatives. The unit is that alternative, not designed to replace the dollar overnight, not designed to start a financial war, designed to function as a parallel system, a financial shield. So how does it work? The design is intentionally simple because complexity does not build trust. Structure does. The unit is built on two foundations. The first is gold. 40% of the unit's value is directly backed by physical gold, not paper claims, not ETFs, not derivatives. Physical metal stored in secure vaults across BRICS nations, auditable and verifiable. This is the credibility anchor. Gold has held value for over 5,000 years across empires, political systems, and wars. By tying the unit to gold, BRICS is making a clear statement. This system is anchored to something real, apolitical, and universally recognized. The second foundation is more strategic. The remaining 60% of the unit is backed by a weighted basket of BRICS national currencies: the Chinese yuan, the Indian rupee, the Russian ruble, the Brazilian real, and the South African rand. This is not about nostalgia or tradition. This is a bet on scale. Together, these economies represent over $28 trillion in combined GDP and control critical resources, including energy, manufacturing, rare earths, and agricultural production. This component sends a very specific message. Our combined economic output is large enough to support a global settlement system. So the structure is deliberate: 40% stability through gold, 60% growth through emerging economic power. Not volatile, not static, balanced. This is not just a new payment method. It is a direct structural challenge to how global money has functioned since Bretton Woods. But does it actually work? Can countries really trade at scale without the dollar? We already have the answer. Because this has been happening quietly for years. Look at Russia and China. As of January 2026, nearly 90% of trade between these two countries is settled without using the US dollar. Oil, gas, machinery, electronics, agricultural goods, hundreds of billions of dollars in annual trade settled directly in rubles and yuan. $0 involved. This is not a projection. It is not a future goal. It is current reality. Russia and China did not wait for a perfect system. They were forced to adapt under sanctions. They built workarounds, tested them, and scaled them. The unit is the official highway that just opened. Russia and China have been driving on back roads for years, proving the route works. Their experience is the proof of concept, and now that concept is being formalized, standardized, and expanded. This is where scale becomes critical. The BRICS alliance is no longer a small coalition. With recent expansions, it now includes major energy producers and large developing economies. Together, BRICS nations represent approximately 46% of the global population, over 3.6 billion people. This system is not launching into an empty market. It launches with immediate users, immediate trade flows, and immediate relevance. Energy shipments, manufactured goods, raw materials, agricultural exports, all of it can now be settled through the unit. That scale transforms this from an experiment into a structural shift. And it explains why this moment matters. Not because the dollar disappears, but because the monopoly ends. For the first time in modern financial history, there is a real operational alternative. What that means and who it affects next is where the story actually begins. Now we move to the real implication. Not headlines, not predictions, not collapse narratives, power. For decades, the United States has enjoyed something most people have never heard of, but benefit from every single day. Economists call it the exorbitant privilege of the dollar. Here is how it works. Because global trade is settled in US dollars, the entire world needs dollars to function. Central banks hold dollars as reserves. Corporations borrow in dollars. Commodities are priced in dollars. That constant global demand creates three advantages for the United States. First, the US can borrow more cheaply than any other country. There is always demand for US Treasury debt. Second, the US can run massive trade deficits year after year. It can import far more than it exports because the world needs dollars regardless. Third, and most important, the US controls access to the financial system itself. Sanctions, asset freezes, banking exclusion. These are not military tools. They are financial weapons. And they only work because there is no alternative. Until now. The BRICS unit does not destroy this system overnight. That is not how financial power disappears. What it does is far more dangerous. It introduces choice. For the first time in 80 years, countries can settle trade without automatically passing through dollar-based infrastructure. That changes behavior. Not all at once, but incrementally. Every time a country settles even a portion of its trade in units instead of dollars, global demand for dollars decreases slightly, not dramatically, but persistently. This is erosion, not explosion. And erosion is much harder to stop, because once alternatives exist, they reinforce themselves. If one trade route works without dollars, others follow. If one country reduces exposure, neighbors pay attention. This is why the unit matters even if its market share is small at first, because it breaks the monopoly. And monopolies lose power the moment competition becomes credible. Now consider who is watching this most closely. Not the United States, not Europe, but countries outside BRICS. Large developing economies: Indonesia, Nigeria, Turkey, Vietnam, Pakistan, Bangladesh. Many of these nations share the same problem. Their debts are denominated in US dollars, Their revenues are in local currencies. When the dollar strengthens, their debt burden explodes. When the Federal Reserve raises interest rates, capital flows out of their markets. Their currencies weaken, inflation rises, economic stability erodes, and they have no vote in Federal Reserve decisions. They are trapped inside a system they do not control. For these countries, the BRICS unit is not ideological. It is practical. It offers optionality, the ability to settle trade with major partners without full exposure to dollar volatility, the ability to diversify reserves, the ability to reduce dependency, not eliminate it, reduce it. This is why the unit's existence alone is powerful. It signals that an alternative is no longer theoretical, it is operational. And that optionality becomes more attractive every time the dollar system creates stress. Every rate hike, every sanctions announcement, every asset freeze, the unit quietly gains relevance. This is how monetary shifts happen, not through announcements, through incentives. Now let's address the asset most directly affected by this structure: gold. Because the unit is 40% backed by physical gold, that design choice has consequences. BRICS nations are already the largest buyers of gold globally. China, Russia, India, they have been accumulating gold for years, not speculatively, strategically. If the unit expands, if trade volumes settled in units increase, the demand for gold backing increases with it. Every new unit issued requires gold reserves. This creates structural demand, not investor demand, institutional demand, central bank demand, and the global supply of physical gold is relatively fixed. This is basic supply and demand. This is why major financial institutions are revising their gold forecasts. JP Morgan has projected gold prices reaching $5,000 per ounce by late 2026. Other analysts estimate even higher levels if adoption accelerates. The logic is simple. An expanding settlement system with mandatory gold backing creates sustained pressure on limited supply. The unit is not just a currency development, it is a structural shift in how gold is used, from reserve asset to active settlement anchor. Now bring this back to the United States. The biggest risk to the US dollar is not collapse, it is relevance. The dollar does not need to disappear for American financial power to weaken. It only needs to lose exclusivity. If countries begin settling trade in multiple systems, the dollar becomes one option among several, and every time it is not chosen, the advantages tied to it diminish. Borrowing costs rise, trade deficits become harder to sustain, sanctions lose effectiveness, not suddenly, gradually. This is why US policymakers are concerned, even if they publicly downplay the threat. They understand something fundamental. Financial power is path-dependent. Once alternative paths exist and are tested, forcing everyone back into a single system becomes nearly impossible. But the unit is not without risk. Its greatest challenge is not external pressure. It is internal coordination. BRICS is not a unified political bloc. China and India have active border disputes. Russia and China have overlapping strategic interests. Brazil's political system differs sharply from Russia's. Managing a shared settlement system requires trust. Who controls monetary adjustments? Who manages gold reserves? Who absorbs losses during crises? These questions have destroyed previous currency unions. The euro nearly collapsed during the Greek debt crisis, despite far deeper political integration. Western analysts are betting that BRICS fractures under similar pressure, that internal contradictions slow or derail the project. But there is a counterforce. Shared vulnerability. After 2022, BRICS nations learned a clear lesson. If you do not control the system you operate in, that system can be used against you. That shared incentive may be strong enough to maintain cooperation, at least in the medium term. And that is all that is required, because the unit does not need to dominate the world, it only needs to exist. Function. Scale gradually. Its success is not measured by replacing the dollar, it is measured by surviving. Because survival alone changes everything. What we are witnessing is not the end of the dollar, it is the end of a monopoly. What comes next is a more fragmented, multipolar financial world, multiple systems, multiple settlement paths, multiple centers of power. And once that structure is in place, it does not revert. At this point, One thing should be clear. This is not a theory. This is not speculation. This is not a future scenario. The BRICS unit is already live. Trade is already happening. Settlement is already functioning. Infrastructure is already built. That alone changes the global financial landscape. For 80 years, the international monetary system operated under one assumption: there was no alternative. Since Bretton Woods in 1944, global trade, reserves, and settlement were built around the US dollar, not because it was perfect, but because it was the only system with scale, liquidity, and enforcement. That era is now over, not because the dollar failed, but because competition arrived. This distinction matters. The collapse narrative is wrong. What we are seeing is something far more subtle and far more durable: a slow structural transition. The unit does not seek to replace the dollar everywhere. It does something more realistic. It removes the dollar's exclusivity. Countries no longer face a binary choice between participation and isolation. They now have options. And options change behavior. When sanctions are threatened, countries can respond with leverage. When dollar liquidity tightens, countries can redirect trade flows. When geopolitical pressure rises, countries can hedge. This does not eliminate US power. It dilutes it. That dilution is cumulative, and once it starts, it compounds. This is why the most important impact of the unit is not within BRICS itself. It is on third-party nations. Countries that are not aligned ideologically, but are aligned structurally. They want stability. They want autonomy. They want insulation from external shocks. For them, the unit is not a statement. It is a tool, a backup system. And backup systems tend to become permanent once they are tested and proven to work. This is how financial bifurcation happens, not through declarations, through redundancy. The world does not split cleanly into two camps. Instead, it becomes layered. Some trade in dollars, some in units, some in euros, some in bilateral currencies. Different systems for different purposes. Energy flows one way, manufacturing another, debt settlement another. This complexity weakens any single center of control, and that is the real transformation. Now consider how this changes global negotiations. For decades, financial pressure was asymmetric. The United States could impose sanctions with limited retaliation. Access to the dollar system was a privilege. Now, that privilege is conditional. A country facing sanctions can credibly say, "We will shift more trade outside your system." That does not eliminate pain, but it reduces vulnerability, and leverage is always relative. This makes negotiations more balanced, more transactional, less absolute. That alone reshapes geopolitics. But this shift also introduces new risks. Multipolar systems are less efficient. They are harder to coordinate. They create friction. Liquidity becomes fragmented. Standards diverge. Trust becomes localized. Financial shocks may transmit differently, not necessarily smaller, but more complex. This is the trade-off. Stability through dominance versus resilience through diversification. The world is choosing the second, not because it is better, but because the first is no longer trusted. And trust, once lost, rarely returns. Now, return to the core question. What is the final assessment of the BRICS unit going live in January 2026? It is not the end of the US dollar. It is the end of an uncontested system. The dollar will remain dominant for years, possibly decades, but dominance is no longer absolute, and absolute dominance is what enabled extraordinary privilege. That privilege is now on a timer, not because the unit is perfect, not because BRICS is unified, but because the alternative exists and works. That is enough. Financial history shows a consistent pattern. Reserve currencies do not collapse suddenly. They fade. They lose share. They lose centrality. They lose influence. And the process is irreversible once alternatives scale. The unit does not need to win. It only needs to persist. And persistence changes incentives across the system. What we are witnessing is the beginning of a multipolar monetary world, messier, more complex, less predictable, but also less centralized. For investors, businesses, and governments, this shift is not optional to understand. Ignoring it does not preserve safety. It increases exposure, because systems change whether we acknowledge them or not. The rules that governed global finance for an entire lifetime are being rewritten quietly, structurally, and in real time. Not with announcements, not with headlines, but with settlement flows, reserves, and infrastructure. The BRICS unit has planted its flag, and once a financial system is operational, removing it is nearly impossible. The game has changed, not overnight, but permanently. What comes next is not chaos. It is competition, and in global finance, competition always reshapes power.